Why does a stock trading near $3 suddenly rip to 5, 7, or even higher in one session? And why do so many traders still lose money chasing that same move? The answer is momentum, a temporary imbalance where attention, demand, and trading activity accelerate together. In the next few minutes, you'll learn what creates momentum, how traders find these names before they are obvious, how a healthy setup differs from a late chase, and why the best-looking chart can still be a terrible trade if the risk is undefined. Momentum trading means trying to participate in unusually strong price movement while the conditions supporting that movement remain intact. It is not simply buying a green stock. Price should be expanding, real trading volume should be present, and the stock should have enough liquidity for orders to move through the market. The goal is to recognize acceleration, define a logical place where the idea is wrong, and exit when the evidence changes. Momentum is a condition. It can strengthen, stall, reverse, or disappear completely. Price expansion tells us the range is widening. Volume expansion tells us more shares are changing hands. Relative volume, often shortened to R-vol, compares today's activity with what is normal for that same stock. A reading far above normal can confirm that today is different. Liquidity describes how easily shares can be bought or sold without huge price impact. Float is the supply of shares realistically available to trade. When demand surges into a smaller float, price can move violently, but the reversal can be just as violent. Momentum fades when the imbalance fades. Early buyers take profits, new buyers become less aggressive, overhead sellers enter, or fresh information changes the story. A stock can still be up 50% while its momentum is already weakening. That is why experienced traders watch the character of the move. Is volume supporting the next push? Are pullbacks holding higher lows? Is price accepting above a breakout level or rejecting it? The percentage gain alone cannot answer those questions. Momentum usually begins with a reason for traders to pay attention. That might be breaking news, earnings or guidance, an FDA or clinical update, a commercial contract, an analyst action, or a pre-market gap. It might also begin with a technical breakout, a sympathy move in a related company, or broad strength across an entire sector. The catalyst answers why now. It does not tell you how far the stock must go, and it never guarantees continuation. The market still has to show real participation. Other forces can amplify the move. A low float limits available supply. Heavy short positioning or rising borrow pressure can make upside movement more sensitive if short sellers rush to cover. Retail and social attention can rapidly increase participation, but each signal has limits. Short interest can stay high while price falls. Social buzz can arrive after the easy part of the move. Low float can create air pockets in both directions. Stronger context comes from several independent facts pointing in the same direction, not from one dramatic number. Now, let's follow the anatomy of a typical move. First comes discovery. The stock begins trading more actively in pre-market, often around a catalyst. Volume grows, spreads may tighten, and a visible resistance level forms where sellers previously stopped the advance. The first important question is not whether the ticker is green, it is whether participation is expanding as price approaches that level. Rising price on shrinking volume can be fragile. Rising price with expanding volume shows that more traders are actually involved. Next comes the resistance test. A true breakout is more than a wick through a line. Traders look for price to clear the level, attract volume, and show some degree of acceptance above it. When sellers at resistance are absorbed, price can accelerate because the next pocket of supply is farther away. This is where candles often expand and scanners light up. It is also where late traders feel urgency. The important distinction is that acceleration confirms attention. It does not automatically create a safe entry at any price. After acceleration, a pullback is normal. The quality of that pullback reveals structure. Does former resistance become support? Does price form a higher low? Does selling volume contract, then buying volume return on the next push? A break, controlled retest, and continuation can offer a much clearer decision point than chasing the initial vertical candle. But if price falls back below the breakout, cannot reclaim it, and volume keeps fading, the move may be failing. The same level can define both opportunity and invalidation. Eventually, momentum reaches exhaustion. Warning signs can include repeated upper wicks, a volume climax with little additional progress, failed continuation attempts, or the loss of the most recent higher low. Exhaustion does not mean price must collapse immediately. It means the evidence supporting continuation is weaker, while the distance to a logical stop is often larger. That combination, less confirmation and more risk, is exactly why a late entry can be dangerous, even when the chart still looks exciting. There are thousands of publicly traded stocks, and nobody can manually watch all of them. Momentum traders use scanners to narrow the market down to names showing unusual activity. This distinction is essential. The scanner finds candidates. The trader still has to evaluate the setup. Appearing on a list is not a buy signal, and a probability score is context, not a prediction. The value of screening is speed and organization. It helps direct attention toward the small part of the market where something unusual may be developing. Here is the Cockpit Control Center serving as one practical example. Its scanner command center organizes different market lenses in one place. A momentum workflow might begin with price and percentage change, then add current volume, relative volume, float, news, and pre-market activity. The objective is not to find the ticker with the loudest color. It is to ask better questions faster. Why is it moving? Is activity unusual? Is liquidity usable? Where are the important levels? And is the move early, structured, or already extended? A momentum screener makes comparison easier. Instead of evaluating one ticker in isolation, you can compare price, percentage change, volume, R-vol, float, and related context across many names. Filters should match the trader's actual constraints. A $5 liquid stock and a thin 50-cent stock may both be moving, but they do not present the same execution risk. After the broad screen, the work becomes more specific. Verify the catalyst, inspect the chart, map resistance and support, and decide whether a clear trigger and invalidation exist. Specialized scanners can answer narrower questions. A pre-runner view can surface names whose activity is building before they become the day's obvious leaders. A momentum probability view can organize several inputs into structured context. The responsible interpretation is never, "This score says the stock will go up." It is, "This candidate deserves review because several measurable conditions are present." Scores can be wrong, catalysts can fade, and market conditions can change. The output begins the decision process. It does not finish it. Finding a momentum stock is not the same thing as finding a good entry. A structured entry occurs near a decision point where confirmation can be observed and risk can be defined. Examples include a break and hold above resistance, a reclaim of an important level, a controlled pullback that forms a higher low, or continuation after volume returns. None of these patterns guarantees success. Their advantage is that the trader can explain what must happen next and identify the level that proves the idea wrong. A chase looks different. Price has already gone vertical. The next resistance level is close. Volume is peaking or fading, and the nearest logical stop is far away. Buying only because the ticker appeared on a scanner adds no plan. Ignoring invalidation turns a trade into hope. The problem is not that an extended stock can never continue. It is that the reward remaining may be small compared with the risk required to stay in the position. Location changes the trade, even when the ticker is identical. This Cockpit Control Center snapshot shows how raw scanner data can become a plan. The interface separates a trigger from an entry zone and an invalidation level, while explicitly warning not to chase. That framing matters more than the ticker itself. A trigger describes the evidence needed before acting. The entry zone describes a workable location. Invalidation defines where the setup no longer behaves as expected. This is a live educational snapshot, not a recommendation, and its future outcome is unknown at the moment captured. Risk management begins before the order. First, choose the maximum dollar amount you are willing to lose if the setup fails. Then, measure the distance between the planned entry and invalidation. Position size is the dollar risk divided by that distance. If the stop must be wider, the position should generally be smaller. Real results can still be worse than planned because of slippage, wide spreads, sudden news, or thin liquidity. In fast names, stops are not magic shields. They are decision tools inside an uncertain market. Borrow pressure, short pressure, and Reddit or social participation can add useful secondary context. They may help explain why a stock is sensitive to demand or why attention is expanding. They do not replace liquidity, price structure, or risk controls. Momentum names can also halt during extreme volatility, reopen far from the prior price, and reverse on a single headline. Low-float stocks amplify both directions. Disciplined traders accept that uncertainty and size positions, so one failed setup does not decide the day. Let's connect the process. A catalyst or unusual activity brings a stock onto the scanner. Volume and relative volume confirm that participation is abnormal. The chart reveals a key technical level. The trader then defines a potential trigger, chooses an entry location only if that trigger confirms, and marks invalidation before entering. In this live CCC example, those elements are visible together, but the outcome is still open. The correct lesson is not to predict what happens next. It is to know exactly what evidence would support continuation and what evidence would cancel the idea. In our completed teaching example, price breaks resistance, holds the first retest, and continues into an extended push. Later, volume peaks, a continuation attempt fails, and the most recent higher low breaks. That is the eventual outcome. The momentum phase ends even though the stock remains well above where it began. Another setup could fail immediately at the trigger. Both outcomes are normal. A good process is not one that wins every time. It is one that defines the decision, controls the loss, and responds when conditions change. Everything you've seen me use throughout this video is part of the Cockpit Control Center from Stonk Emporium. If you'd like to explore the scanners, market intelligence, charting, and trading tools yourself, you can take a 3-day VIP trial completely free with no credit card required at scstonkemporium.com. This content is educational and informational only, not financial advice. Trading involves substantial risk, and past performance never guarantees future results. Build the plan first, respect invalidation, and let evidence, not urgency, drive the decision.